to Ameera Shah, the promoter and managing director at Metropolis Healthcare Limited, to understand how can these concerns be met and what is their growth strategy going forward. First up, Ameera, hi, good afternoon. Thank you so much for speaking with ET Now. Now, this time around, the revenue was pretty much flat on a YOY basis. What is the reason for that? And could you throw more light in terms of how the non-COVID business is doing and what are the updates with respect to the COVID business as well?
Yeah, I think healthcare and especially diagnostics industry has gone through, from a financial cycle basis, a very challenging last 2 years, right? Because any apple-to-apple comparison has been quite difficult. So we have to remember 2-3 things to get some clarity. Number one, Q3 is always the weakest quarter of the year. And therefore, any comparison has to be only done to the year before and not the quarter before. That's number one, because this is very normal that Q3 is usually weaker than Q2 in any year pre-COVID or post-COVID. Number two, if you look at Q3 this year compared to Q3 last year, you'll see the numbers are flattish on the non-COVID side. And the reason for this is we had already guided at end of Q2 that the government contracts that we have are showing some lumpiness quarter to quarter. And therefore, in Q3 would not be giving any significant revenues, and therefore it would be lesser. So if you actually separate the government contracts and the COVID business, if you look at the core business, we have seen a 31% growth year on year and a positive percent even if you take out HighTech, just MHL alone. So I think the challenge only came because of the government contracts, and if those had come, we would have seen a significantly higher growth in Q3.
What are the synergy expected from HighTech acquisition going ahead in order to fund this acquisition, which currently has a debt of 285 crores? There has been an increase in working capital. How will the debt repayment take place?
Sure. So I think 2-3 different questions. So first I'll start with synergies. So if you look at HighTech, the positioning of HighTech in Chennai has been number 2, while Lister Metropolis has been number 1. And in ROT and rest of Tamil Nadu, HighTech has been also quite strong along with Lister Metropolis in different locations. And they also have a lab in Bangalore under the HighTech company. So what we are doing is we are following a dual brand strategy in Chennai and a single brand strategy for rest of Tamil Nadu and for Bangalore. And the idea is basically that we think that both these brands, HighTech and Lister Metropolis, can continue to grow really well in the market of Chennai, and we will expand the HighTech brand in Chennai. We're looking to add about 100 centers and really to take up the level of infrastructure, experience, technology, convenience, all of that for the patient. So I think it's going to have a lot of revenue synergies as well as obviously on the back end on cost synergies without affecting anything negatively for customers, employees, and only improving it. As far as the funding of the acquisition, we had spent approximately 350 crores out of our own cash that was there in the company before, which was between 300 and 350. And we had taken approximately 300 crore debt from 2 banks, of which we have already paid back 15 crores, and therefore the net debt left is 285. Our plan is over the next 2 to 3 years to pay off this entire debt from our internal accruals. And we don't see too much of a challenge at all in doing that. As far as working capital is going up, it's a very minor quarterly issue. Actually, if you see our receivables has come down, net receivables has come down from 41 days to 31 days across the group, which is a fantastic progress. And it's only because we were stocking a little bit more of inventory, paying vendors a little bit earlier that we have seen sort of an increase in the working capital days, but otherwise nothing significant.
Okay, so the net receivable cycle has come off and there is a clear roadmap for debt reduction as well. But talk to us about the future outlook in terms of expansions. What could be the margins going forward? And we were just speaking with your colleague from MedPlus earlier. They are going big bang on digitization. What's your take on that?
Yeah, I think, we have to always look at everything from a longer term perspective. And I think it's very important not to look at things only quarter by quarter. I think overall healthcare in India continues to have a humongous scope over a period of the next 3 to 5 years. Excuse me, we have to remember very few number of people, single digit percentage of Indians have ever been diagnosed with any sort of test. And therefore there is a huge market opportunity to be able to take branded, standardized, very good quality testing to all of India. And we continue on that journey. In this quest, we had decided that we would open 90 labs and 1,800 centers in the next 36 months. And we had announced this early in this financial year. And we're very much on our track where this year we should open approximately 20 new labs and about 600 odd collection centers. Next year, about 30 labs, and again about 600 centers, and the third year, about 40 labs. And complete this expansion of 90 labs. This would then take us to approximately being present in 320 cities all across India. Which currently we are at about 210 or 220 cities approximately all across India. So I think we are very positive and optimistic on our geographical and network expansion. We're also doing and investing a lot on the digital side, not only in teams, in automation, in personalized campaigns to consumers, in really building the tech stack at the back end to be able to become truly omnichannel. And we believe that making those investments is smart at this point of time. So I think we're doing all the things that are necessary for building a strong and robust long-term business for Metropolis. I think as far as margins go,
Thanks so much for that, Ameera, talking to us about your company, the way ahead. Of course, markets have been slightly disappointed from the non-COVID test, the way ahead, and how the margin picture is now. Earlier, 30% was the street estimate, and now it's suddenly struck down to 25%. And that's the reason for this de-rating that even my colleague Sharad was just pointing out too.